Good afternoon, everyone. My name is Tim Andow, and I'm the Director Principal here at Andow Ellis Chartered Certified Accountants based in Bristol. Today I'm joined by Clifton Wealth Management, and they're here to guide us through the tax efficiencies of pension contributions, business investments and protection. The session is being recorded, and so by attending, you're agreeing that any contribution made can be shared. If you have any questions, please enter them in the chat box and I'll bring them up during the session. Andy, over to you.
Okay, thank you then, Tim. Good afternoon, everybody. My name's Andrew Down at Clifton Wealth Management, Chartered Financial Planner and one of the principals alongside John Barnfield. So bear with me just for a moment and I'm going to organise my screen share, which that should be visible, I hope, Tim, to everybody on the webinar this afternoon. So we'll kick everything off then. Bit of an introduction. Clifton Wealth Management Limited, run by myself and my colleague Jonathan Barnfield. The business, it's been running for about 28 years and I have been involved for 8 of those. We're based in the heart of Clifton Village in Bristol, and largely we probably look after clients that are within an hour or so of Bristol. But saying that, we do also have quite a few that are scattered around all the way in quite a central bit in London as well, which actually a lot of this virtual working has helped quite a bit with that, because we would traditionally be doing an awful lot of travelling in the cars. So adopting the technology has probably been quite helpful on that front. So what is it that we do? We specialise in investment planning, protection planning and financial retirement planning for individuals. We do it for business owners and families. Bit of housekeeping in terms of all of the slides that I'm going to be going through for this afternoon's session. All of the information, taxation, financially wise, it's all relevant to the current 2021 tax year. And in terms of the presentation, this is a bit of a run through about what we do. Obviously, it's not personalised advice to any of the participants, but if there's anything that I'm going through that chimes or you'd like to hear more about it, then please do feel free to contact us separately. I'm going to be sharing our contact information at the end of the webinar so that you've got the opportunity to do that. Alongside this, as I'm going through some of the topics, Tim has also said you are able to raise questions with him and he will interject and raise them with me. And hopefully I will be in a position to answer those as long as they're not too difficult for me this afternoon. So moving on. Next slide, please. The infamous phrase of Boris Johnson throughout the last 9 months. So what is it that we're going to be looking at? Tax efficient profit extraction for business owners and ways and methods to achieve that. I'm going to give you a bit of a run through of all of the valuable financial allowances and tax reliefs that people should or could be using. I'm going to do a little piece on business investments, so actually investments within a corporate structure, business protection, and ultimately what I'm hoping to achieve is, by running through all of these topics in the presentation, it'll be posing the question to yourselves: are you on track personally and as a business? So I'm going to start with this slide just by way of a bit of background, really. So the slide here, it's just giving a bit of a summary over the last 100 years of government spending as a percentage of GDP. And the reason that I'm bringing it up is actually the 2 areas that have seen the largest increase over this time frame and now represent a much higher amount of public spending are the 2 areas which are circled here: pensions and healthcare. So pensions, on this point, we're talking about the state pension. So a bit of detail on that. It's gradually been watered down over the years because it's become more and more expensive for the government to administer. So the minimum requirement for the full basic state pension is now 35 years of qualifying national insurance contributions. And it's very simple for people to check how they're progressing in that journey by the completion of something called a BR19 state pension forecast form, which the DWP will be able to confirm how many years you have and whether it's possible to purchase any additional years, etc. So just looking at this, the key is that the cost to the government for administering these services, it's increasing. We do not believe that it's going to be sustainable on the current basis. And the reason for that is that people are living longer, of course, with advances in medical healthcare, and are spending much more time in retirement. So increased life expectancy, it's going to be putting a much greater strain on the state pension system, which is why realistically it's going to be more and more critical for people to be aware of what it is that their businesses can offer and actually chart a path and plan your own personal provision. Because the reality is, I think, the public pension system, it's probably not going to be there for us all in the future in the same capacity. So this is a bit of an example, and this slide here, the purpose of this one really is just highlighting life expectancy and its major impacts on retirement planning. So mid 20th century, people would have expected to spend 8 years in retirement with an average life expectancy of 70 years old. We wind the clock forward 60 years, 50, 60 years, and actually people who are being born at the end of the 20th century, the increase in life expectancy has resulted in, almost a 4- or 5-fold in the years spent in retirement. So actually, people are spending as long in retirement now, potentially, as they have done working. And we've already mentioned that the way that this is going to be funded, it's been changing. The state pension, whilst that used to represent 10% of a 50% final salary, which would have been perhaps a notional target that final salary pensions would have targeted, the reality is that there are already changes that have taken place to the state pension, which have watered that down. And who knows, it could become one of those benefits that ultimately is a means tested benefit, which means it may not be there. So in terms of conversations with clients and everything, we tend to have the conversation, be aware of it. But I think it's probably more prudent to discount that and treat it as more of a bonus in one's retirement planning. Defined benefit pension schemes. These were the golden goose of retirement planning, dead simple, pretty much all sponsored by the employer. And they provided a guaranteed income in retirement that would increase with inflation. It would provide spousal benefits in the event of death. But much like the state pension, people living longer, it became completely unaffordable for private companies to continue offering those benefits to new members. So gradually the provisions were watered down, and actually I don't think there's a single FTSE 100 business anymore that actually has an active defined benefit pension scheme. It still exists in the public sector space, but that's of course heavily subsidised by the government and the taxpayer. But even the definitions under those new schemes, they've been watered down tremendously. So ultimately, the bad news is there's more and more being put on the individual to make sure that they are saving effectively for retirement planning. The good news is that actually there are some pretty simple behaviours which can help to ensure a healthy outcome for people. And that's what we're going to have a little look at now. So this is a hypothetical situation, but something that many business owners may find themselves in at some point. There's 3 routes, mainstream routes, for business owners to extract money from their company for personal benefit. So this is a hypothetical which is exploring a sum of £20,000 pre-tax cost to the company. And it's just working through the various avenues for how that could be extracted and ultimately the taxation differences. So the first one, it's looking at £20,000. And this particular example, it is assuming that the individual is a 40% high rate taxpayer. But the figures don't change dramatically if you ran it as a basic rate taxpayer either. because on the salary, the company national insurance would still be there, and actually the individual national insurance under the higher rate threshold would be closer to 12% as opposed to 2%. But ultimately, we can crunch all of the numbers. So £20,000 taken as salary. Ultimately, what does that mean for the individual? They're set to gain currently just over £10,000 net benefit. So almost 50% has been lost through various taxation. Dividend. Well, traditionally, lots of business owners will favour dividends over salary for drawing personal remuneration. And as a higher rate taxpayer, £20,000, it would net out at just under £11,000. So it is better than obviously the salary outcome here. The main difference being the national insurance saving. Now, the third option, which used to be called mystery option, but I've given it away here, and it's got its true name, which is an employer paid pension contribution for the business owner. £20,000, it comes out of the business as a tax deductible expense. It goes into the pension fund, and at a point in the future, this assumes no growth on the fund, but if the individual were to draw down that £20,000 and actually they still found themselves to be a higher rate 40% taxpayer, it will all net out with a £14,000 net sum being made available. So what I'm not suggesting here is that money goes into a pension and it's immediately withdrawn, because actually on paper it could prove more tax efficient. But what it's saying here is that for excess company money that we're trying to get out of the company, ring fence in something that can be of personal benefit in the future and hopefully be put to work in the meantime, from a tax efficiency point of view, it's definitely something that is very favourable. And if you were an employee of a large company and you had a similar roles and responsibilities to what you would do running your own business, actually you would be expecting these contributions to be coming out of that company, employer paid pension contributions, as a part of your overall remuneration. But I think sometimes as business owners, we're all quite guilty of just making sure that the day-to-day, looks healthy, and obviously focusing on working within the business. But actually, prioritizing employer paid pension contributions, it's a very tax efficient thing to look at, and will put you in good stead for future planning. The next slide, there's two ways that you can pay into a pension. We've just discussed the first one, which is company paid pension contributions. This slide is just highlighting the fact that actually you can also make them on a personal basis. So once you've received money through remuneration from your company, there are rules as to which type of remuneration can be invested into a pension. And it's usually PAYE income for company directors, or net profit for sole traders. This is what you would be looking at. And essentially you pay your net money into the pension fund. So again, if we just take this example here in the middle, higher rate taxpayer, for every £60 you pay in, actually, effectively £100 will be being put into the pension, because the government will be offering tax relief on those personally paid contributions. So in terms of the efficiencies of this here, when I talk to pensions with clients, I kind of describe them as one of the many different tax wrappers that can carry the different tax reliefs. And the tax reliefs are beneficial because they reduce investment risk. So for example, higher rate taxpayer, immediately you've made 67% as a day one return just through the tax relief. It can improve returns on the money, because actually, rather than it being sat in a bank account somewhere, it could be put to work over a sensible time frame into a suitable investment portfolio that could yield higher returns for you. And ultimately, it's about creating a fund that will generate more flexibility for you as an individual in retirement, and ultimately give you more choice and more options at the point that you do stop work. So just a little bit of a roundup on pensions. A few points to consider here. Very tax efficient wrapper, As such, there are limits as to what you can put in on an annual basis. Annual allowance, £40,000. But actually, if you were found yourself in a position where companies could support higher earnings or higher contributions rather to play catch up, you can make use of previous tax years, the previous 3 tax years, to make use of something called a carry forward rule, which could actually see a big catch up if somebody hasn't really focused on retirement planning, but does find themselves in a position to look at that. There is also something called a lifetime allowance, which is a ceiling for pension benefits before all of the tax reliefs then start working against you. And that ceiling is equal to pension benefits that are in excess of just over £1 million. So there's plenty of scope for most people to really make use of the pension rules and benefits without getting to the point that it becomes punitive. Pension freedoms. What do I mean by that? So we've talked about putting money into a pension. I'll talk to you in a moment about what you do when it's in there. But ultimately, what happens at the other end when you do look to try and access some of the money? You can access pensions at the moment from age 55, although from 2028, we're expecting that to increase to age 57. And it's basically keeping 10 years behind the state pension age. So you can access a quarter of the fund free of tax, and then the remaining fund, traditionally what was done was to purchase an annuity, but the annuity rates are now so low that the more modern way of accessing a pension would be flexible access drawdown, where basically you've got a pot that you've built up. The investments would need to be looked at to ensure that they remain appropriate, but ultimately you've then got the ability to just draw an annual or a monthly income on a tax efficient basis direct from the investment fund, and you draw down from the investments at the point that additional income or capital is needed in retirement. Consolidation of historic arrangements. We spend an awful lot of time doing this for clients because actually most of us have got a number of historic arrangements in place, whether they're old workplace pensions or old personal pensions, and we look at them all of the time. And actually, one of the interesting statistics that I think we all want to avoid, at the moment, there's estimated to be about £9 billion of pension assets on the unclaimed assets register. So these are old historic arrangements, people have forgotten about them and have never claimed them. So, it's a valuable benefit to be had. Quite often there'll be a number of different historic arrangements. It's sometimes a good idea to establish whether there are any particular benefits on any of those, or if not, a consolidation exercise can actually be quite a good thing. Have a look, make sure they're invested appropriately and all pulling in the same direction. As business owners, quite often a question comes up about, is there a time where the business will want to or look to buy its own commercial building to trade from? Well, certain types of pensions, SIPs, self-invested personal pension, and also SASs, they do offer the ability to actually buy a commercial building that a business could then trade from. So there's various tax efficiencies that are involved with that, and also quite a few T's and C's. But if that's something that may be appropriate, it's something that could be looked into. Inheritance tax. There's lots of examples where I've met with clients, and for some reason, from out of the gate, they seem to be very dead against pensions. And I think it's probably just a misunderstanding. And actually, this point here is probably, if I think about it, it's the stem of a lot of them. And going back to historic pensions, you would have saved for years, you would have built up a pension fund, you would have then bought an annuity, which is a guaranteed income from an insurance company. And if or when you died, actually, a lot of that fund value would have been lost because the insurance company, perhaps they would have paid a dependent's pension to your spouse. But ultimately, there are examples of people saving up for ages, buying an annuity, and unfortunately just not having the retirement time that they thought. And the pension benefits would have been lost under certain examples via an annuity. That's completely changed. And actually, from a pension perspective now, if we're looking at drawdown, if something happens to you and you don't get to spend all of the money that you've stashed away in a pension for your retirement, it passes on to your beneficiaries, which could be your spouse, it could be your children, it could be your grandchildren, and it's also free from inheritance tax. So, even if you don't get to spend it, which is perhaps the primary purpose for most people, it can create a very tax efficient legacy for future generations. Children's pensions, I thought I'd mention that one. You have the ability to pay into pensions for children, so from the age of 0. And there are T's and C's as to how much that can be put in. But the biggest advantage, I suppose, for paying in at such an early stage is that for a newborn, we're probably talking about 60 years of compound growth. So even if there's family members that perhaps would be in a position to consider putting provision in place for a grandchild, even if they only did that for a limited time frame whilst that child was growing up, it would have a substantial impact on their overall retirement planning, because those contributions would have benefited from that compound growth over such a long time frame.
And Andy, sorry.
Yeah.
So you talked about the annual allowances for the pensions. Is there a minimum income level that you need to be able to contribute to a pension?
There is not, no, because even if you don't have any UK relevant earnings, so by that I mean salary or net profit, basically, there is an allowance that the government just accept, and it's £3,600 gross per annum. So you crunch the numbers after the tax relief, it's roughly about £2,800, £2,900 that anybody could put in, irrelevant of their earned income, and it would be grossed up to that 3,600 figure. Okay,
and thank you, Andy. And the other question I was going to ask is that the £40,000 a year allowance.
Yes.
At some point, does that get reduced if you're a high earner?
Yes, it can get reduced. It gets reduced if you are a high earner, as you say, but there have been some changes to that now, which basically means that you have to be earning quite a lot and drawing it personally before the tapering of the annual allowance now takes effect. It used to take effect once your earnings exceeded £150,000. But the government changed that, I think primarily actually due to medical staff and the fact that they were retiring early because they were being penalised for staying on. But the threshold is now much higher. So you'd have to have earnings of over, I think it's 210,000 before anything starts kicking in. And even then it's a gradual effect up to 300. So it does to a degree, but it's probably not your everyday income that would cause that.
Okay, thank you.
Okay, perfect. So this is something that gets thrown up quite a bit when I talk to business owners, and quite often we all like to think that we're working, and the reason that we've chosen not to be employed is we're growing our own business, and hopefully actually that's an asset in itself. And one day, who knows, that could actually form a part of our own retirement planning by way of a business sale. So there's a few things that I try to discuss with people when we have that conversation, basically. And the first is health and well-being. Obviously, as an owner of a business, quite often you're heavily involved in the running of it. So if you had any impacts on your health, that could obviously have a significant bearing on the value of your business and the marketplace for people that would be willing to take that on if you just had to completely step back. Obviously, the last 9 months has thrown something up that none of us have ever really lived through. And that's the effect of something that we just could not predict. So in this case, COVID-19, that could have a massive impact on somebody's business. For example, if you were in the hospitality sector, perhaps you were hoping to retire in 2020. COVID-19 hit. There's probably no way you'd be able to sell your business, certainly not for what it probably is worth under normal operating conditions. Sector decline, lots of examples of that happening. The world's changed. Most businesses obviously adapt to it, but you do get the odd few that things just change over time. And a business that looked good 30 years ago actually it probably doesn't really have much of a place in 30 years' time, and that will affect business valuations and business pension, as it were, if you viewed your business as that. And ultimately, one of the other advantages to taking a bit more of a hybrid approach is that actually diverting some of the company money into high quality global companies within valuable tax wrappers, it diversifies away from those risks, and actually it can give some pretty decent returns as well. So this is about a 20-year snapshot, and it's just saying by using tax wrappers such as pensions, you can access global companies as opposed to just, nationally based companies that perhaps you'll own and you'll be working within. And this is looking back at historic trends, but £100,000 invested in January 2001, we roll the clock forward 20 years, and actually by looking at these things, diversifying and using a pension wrapper, you can access global markets. And these are just a couple of examples. Emerging markets, the blue line, the S&P 500, so that's the American index, and the red line is the UK stock market, FTSE 100. And you wouldn't have a pension that would be invested solely into a single market, but the point of the slide is to say over a sensible time frame, these things go up and down, but actually you can diversify away from your business. And we've got returns here from different things ranging from twofold, fourfold to sixfold. And it's just making the point that diversification, potential for long-term growth in these things, that's what's going to help you in the future as a bit of a diversifier to provide a retirement income. A couple of other allowances that I thought that I'd mention. We've talked about the pensions, I think at this point. ISAs. So these vehicles, they need to be funded on a personal basis, so the company can't pay into them. But once monies are invested, it's treated the same as a pension. So it's tax-free growth within the portfolio year on year. And when you come to access the benefits, it's accessed tax-free. So you don't get any tax relief when you pay money into an ISA, but the flip side is you don't pay any tax when you come to draw upon the benefits in the future. So it works slightly differently to a pension. However, actually using these tax wrappers, they do different things, but having the option to draw money from different things in the future can make a big impact on what can be funded from a tax efficient income at the point that you do retire. These next two on the right hand side, venture capital trusts and enterprise investment schemes, they're not your mainstay, I would suggest, in financial planning, but in certain circumstances, they definitely do have their place. There's tax relief that's given on money that goes in, money is deployed. They tend to be more liquid than ISA and pension investments. And there's tax efficient benefits. And it's probably circumstances would dictate the use of these. It's not a mainstream tool, but there are some good tax allowances and reliefs that are available through these. And in certain circumstances, they can prove quite helpful. Couple of things that I thought I'd touch on. Buy-to-lets. Obviously, that has been a big area of investment for people in the UK. I think Tim would probably agree that in recent years, the HMRC turrets have definitely turned toward landlords in that respect. And as such, the tax benefits of buy-to-lets, they're certainly not what they used to be. And they're not as tax efficient as some of the other things that we've discussed there in terms of pensions and ISAs. So it's now more costly to purchase an investment property, extra 3% stamp duty, mortgage interest relief. That's changed, and the way that that's calculated is now more punitive. No longer do we have the 10% wear and tear allowance that could be offset against rental income. And ultimately, even the capital value of the building now, once it's sold, it's got its own unique tax rate under the capital gains tax regime, and it's actually far higher than any other assets. So things are changing. I think buy-to-lets, perhaps, they still do have their place potentially in a portfolio, but I think from a tax efficiency point of view, we can probably all agree that they're not as tax efficient as some of the other options. This next slide is an interesting one. It's about a 30-year snapshot, and in the UK, we have a fascination with residential property, and this is an average. I take that, and some areas will have done better than this, some will have done worse. But the red line along the bottom here is the Halifax Property Index total return. So it's assuming that rental yields, etc., are accounted for. And it's just comparing the return on average for residential property to other assets. So in this case, we've got the American stock market and the UK stock market. And it's just making people aware of the fact that, yes, buy-to-lets have their place, but by using some of the tax-efficient wrappers and accessing global markets, actually, there are growth potentials that are able to be accessed, which have done as good a job, if not better, than some of the average returns of property in the UK. So, next topic, business investments. So there are certain situations where businesses may not wish to withdraw money that's sat within the company on their balance sheet. And that may be that actually it's, saving for something in the future, or we've already made use of all of the allowances and tax reliefs, and it's just far too punitive to withdraw money from the company at this point. And actually just retaining the earnings on the balance sheet might be a good strategy for a time. Now, the issue that we face in that situation is the interest rates at the moment on cash accounts, extremely low. Bank of England base rate, 0.1%. It basically means that the cash deposits, they're just not doing anything at the moment. And if you factor in inflation, actually, it's costing you probably 2% a year just holding the money in cash. So cash is suitable because in the shorter term, it provides a safe haven, and realistically, to consider some of the options on the business investment front, we need to be establishing what I would refer to as a medium term. So five years plus. And if actually there are examples of companies that are sat on money within the balance sheet, and actually there's no set view for what those funds are going to do in the shorter term, there are options that we can look at within the company that would allow opportunity for that capital to be put to work tax efficiently. The corporation tax will be paid, but there's different ways to structure that. And it will be dependent on the size of your business as to which solution would be best. But in conjunction with Tim, that's something that would be very easy to establish. And just as a flavour, this is a 5-year time frame. Again, it's historic and it's not necessarily an indication of the future. However, this could be an example where January 2016, business had surplus funds. It didn't wish to commit those to anything in particular, didn't want to distribute them. And actually, we roll the clock forward 5 years. And actually, if we had done nothing, the returns would have probably been just above the horizontal axis because the cash returns would have been next to nothing. Yes, the other options, we've certainly seen some volatility. And actually, this significant period here was early March. And, within this, it's capturing the effects of COVID-19 and also the entire Brexit process pretty much. And actually, it's been up and down, and these are different indexes here. But actually, even if we averaged somewhere in the middle of all of this, it would have generated a much higher return on those company funds than would have otherwise been the case. So it's something to consider if the circumstances are appropriate for some business owners. So I love this next slide, and I just wanted to put it in. This is interesting, and what it's basically posing the question is, if we've established that there's surplus funds, perhaps they're going into a pension, perhaps they're staying in the business, maybe we're using other allowances, ISA allowance, etc. Where's the future growth going to come from? Because I don't think it's going to be from the West with our aging societies. We've had our baby boom, and actually all of those people are now retiring. This green circle here it's obviously Asia, and within that green circle, it contains 51% of the global population. 22 of the world's 37 megacities are within that green circle, and companies are fully aware of that, global companies, and they are taking advantage of it. And actually, if all of the governments in these areas are able to do the right thing, there is the demographics within these areas. There is a huge growing middle class population that if the economies are growing, they will be looking to enjoy all of the same opportunities that we've enjoyed in the West. And as I say, global companies are fully aware of this, and our fund managers are aware of it, and they are looking to position funds for the medium to longer term to hopefully capture this growth within the portfolios. So it's just a visual representation that actually we're beavering away in our businesses. That's our priority. But for our long-term planning, arguably, actually, there's a completely different area that we need to be focusing on to try and capture the opportunities. Now, the final topic of the day, we're talking about protection for companies, and largely it can take a couple of different forms. The first one is shareholder protection, and essentially this is applicable to a situation where you have a business that has more than one owner, and the question or the issue that this helps to solve, this type of solution, is in the event of a shareholder becoming either very ill or actually dying, what happens to the shares that person owned? Do they pass to the estate and actually other family members who the other shareholders of the business may or may not know, or certainly probably didn't envisage going into business with? And how does all of that work? And essentially, a solution can be crafted that makes use of a life assurance contract, a double option agreement, which is a legal agreement, and a business trust. And I've got a real life example in a moment of this situation that I think will bring it to life. But essentially, it creates a solution whereby somebody passes away. How are those shares dealt with? How do the remaining business owners continue to run the business effectively? How does the estate generate a value from those privately owned business shares? You know, there might not be a big market for those. So actually using an insurance contract, it can create money for the business to buy those shares from the deceased estate. The estate's happy because they've managed to step aside, have a fair valuation for the shares of the business. And hopefully the existing shareholders are happy as well, because they haven't had to consider borrowing or anything like that. They have maintained complete control of the business and all of the shares. That's one type of insurance, which is quite common, something that we look at in that situation. Another one, which is probably more applicable to most small businesses, is another type of insurance policy, which is called relevant life insurance. And what that policy is designed to do, it's a really tax efficient way of setting up family protection money. So, you know, in the event that a shareholder or business owner has family, children, etc., perhaps they're dependent on that person being able to work within the business, this type of insurance contract, it's paid by the business. It's a tax deductible expense for the business. And in the event that something happens to that person, it can pay out a lump sum into a trust that it's designed not to deal with the shares or anything, but it's designed to create a tax efficient legacy for the family to make sure that actually they don't suffer any of the financial consequences of that person not being able to work and bring home an income. The third one that I thought that I'd mention is another one, which is called a key person insurance contract. And that's one for businesses where actually they have valuable human capital assets. So it might be a fantastic sales director that's responsible for driving lots of the revenue for that business. It might be somebody that's just so specialist with a certain type of work within the business. And this is an insurance contract that the business takes out, that if something happened to that person, they became really ill or they passed away, that could create quite a big impact and delay for the business to get back up to full speed. So the thought process behind this type of contract is it creates a capital sum, it gets paid to the business, that will replace lost profits or lost earnings, and also it will create a fund to hopefully recruit and train a replacement for that role to be picked up in the medium term. So there's lots of different things that we can get involved with. What are they designed to do? Ensure business continuity, make sure that funds are available to the right people at the right time, set things up tax efficiently, and this is in the case of shareholder protection, create a market for private company shares. So this case study that I mentioned, it's a local one, that's why I picked it. It's the court case of the AMT Coffee Company, and you'll be free to Google this, and there's all sorts of information on it. But essentially, it was a coffee company that established in Bristol, and it was set up by 4 brothers. One of the brothers, they died unexpectedly in 2006, and he had a 25% shareholding in the business. His widow and sons inherited his share of the business. However, the other 3 brothers, they have not actually been paying out dividends or anything like that. They've been taking their remuneration separately via directors' loans. And essentially, they've cut the widow and the family out of the profitability of the business because she had a minority shareholding. The other 3 brothers could control the business and control the dividend policy. So she was unable to receive an income, and actually the business didn't buy the shares from her either. So it's been running on and on and on for years. And actually, when putting the slide together, I did dip in and try and have an update, and it was going through all of the courts and everything. And I think the latest was that the 3 brothers were ordered to make an interim payment to the widow and her family of £1.5 million. But actually, apparently that hasn't been paid. So the situation rolls on with the AMT Coffee case. But essentially, it's a situation where no doubt it's caused stress for the entire family, arguably probably more for the widow and the family. But also it must have caused all endless headaches and liabilities for the 3 remaining shareholders. But this is a situation, real life, it's still going on. It could have been so easily sorted if the business owners had sought advice and we'd put in an appropriate shareholder protection strategy for them. And it would have meant that actually there would have been a very simple process that would have dealt with all of this. So just an example, a local example, as I say, that I thought would bring this to life for everybody. So that's me done for the time being. Bit of a summary here. What's the idea of all of this? Earn it financially, keep it and grow it. Take heed of all of the allowances and reliefs, and hopefully, where applicable, try and use those wisely. There's always going to be uncertainty going on in the world, but to be honest, I think that that's even more of an incentive to plan ahead and look to take action. Contact details. This is the company's contact details, address, telephone number, and our email inbox. So if anything that I've run through here has either resonated with anybody directly or has presented questions, we'd be very happy for you to contact us directly to discuss any personal inquiries. And all of that will be conducted on a no obligation basis. Opportunity to perhaps sit down as on a one-to-one and try and understand what's going on and establish actually whether there's anything that we could do that may be beneficial. So Tim, I can see that you've popped back up on my screen. I think that's it for me, unless either you or anybody on the webinar has thought of any questions.
Thank you, Andy. That was really interesting. Yes, as Andy says, if you've got any questions, feel free to drop him an email. I think it's fair to say that everyone's circumstances are different, and it needs that individual attention to everyone's circumstances to get to a full understanding of what's going on and what they're trying to achieve. And I know that, Andy, you've certainly done that with my own affairs. And I think that I've got a question popping up now. Do you specialise in setting up trusts?
We are able to set up trusts, yes, but it's quite a specialist area. So trusts can be very, very far reaching. There's certain types of trusts that we deal with and we're very proficient with. Other types of trusts, probably not so, and it's more of a legal avenue that would probably be the most beneficial. So it depends on the purpose of the trust and the objectives, basically.
Okay, thank you. Okay, we'll just hang around for a couple of minutes to see if anyone else has any questions that they'd like to pose. As Andy said, this is all current information, and there's no advice as such given through this session today. It's information to help equip you to kind of know the right questions to ask and what to look at and what to consider going forward. We'll have to wait and see what happens on the 3rd of March if Rishi changes any legislation that affects any of this.
Yes.
Who knows what he may do. Right. Nobody else is asking any questions, so I think I'll draw that to a close. Andy, thank you very much. Thank you for those that have attended. This has been recorded, so it'll be posted as necessary. And look forward to seeing you again. Andy, thank you very much.
Okay, thank you everybody. Bye-bye.
Thank you. Bye-bye.